Well, the Trans Mountain Pipeline expansion finally starting to move oil a dozen years and $34 billion after that project first got started. Taxpayers technically own TMX, so the fate of the pipeline, I suppose, is in everyone's backyard. The Globe and Mail did a deep dive on the future of TMX over the weekend. Andrew Willis with the Globe here to talk a little bit about really what has been one of the biggest infrastructure projects that we've seen in the country's history.
Yeah, and look, one of the most tortured and overpriced and least cost-efficient projects in the country's history. So sure, let's celebrate the fact that we got it done. There's something to be said that this pipeline is built. It will achieve a very important strategic goal, John. I think, as you know, it's going to allow Canada to stop selling oil just to the United States and to U.S. refiners. It opens up the West Coast and tankers, which means we can start exporting to Asian refineries. It diversifies our customer base, and that, in turn, is hopefully going to improve the price that Canadian producers get for Canadian oil. So the economic outlook is, the economic argument for this pipeline is sound, but my goodness, what a journey to get here.
Yeah, what stands out to you in the slow road towards the finish line here?
Well, look, this is a high-profile example of all the problems that come with trying to develop infrastructure in this country. First of all, you had the permitting processes, then you had the pandemic issues, so construction got delayed, and finally you have Indigenous groups who have been really split as a community on this pipeline. Which is not surprising. Different Indigenous groups have different goals. So you've got a lot of Indigenous groups who really like this pipeline. They want to actually own a stake in this pipeline. We should probably talk a little bit about that.
Yeah.
And then a number of other Indigenous groups that remain opposed. So yeah, it's been a controversial project right the way through, reflecting what happens around a lot of infrastructure projects in this country.
I mean, you're in the business of deals. You always have the scoop on what's happening. So just in terms of how we think about the ownership, really heading into tomorrow, I think that's the important part too, right? That the government stepped in to get this done, but there's always been a dialogue around what the ownership structure looks like down the road.
The government has been very clear. They do not want to be the long-term owner of this asset. So the question is, where is it going to go? And there's who is going to end up owning it? And really, there's two scenarios out there, both of which start with Indigenous participation. So there are First Nations groups basically saying, we're willing to buy this pipeline. It's an operating pipeline right now. That's what people need to remember. What we're talking about is an expansion of an existing pipeline. And that's important because it means there's an operating team in place. That team was built by Kinder Morgan. Kinder Morgan exited, but they're very competent operators of pipelines. So that operating team could theoretically run this pipeline. And there are Indigenous groups saying, we want to buy 100% of it with backing from contracts that are guaranteed by the federal government. And we want to operate it with the old Kinder Morgan team. So that's scenario number one, John. Second scenario is that one of the big Canadian operators buys at least a stake in this pipeline. They take it over. They try and get some synergies out of the operations. And the name you should keep in mind is Pembina Pipelines. They have said consistently, on the right terms, they'd like to operate this pipeline. They'd like to buy it. And there are a number of Indigenous groups willing to back Pembina and own it as some sort of a partnership, probably a 50-50 partnership. So Ottawa's got to make a decision on what kind of ownership outcome do they want. The involvement, though, of Indigenous groups gives this project something very special, what we call social license. That, you know, if you have Indigenous owners in a oil pipeline, it makes it that much more palatable all around, and it aids the government towards reconciliation, which I think we all recognize is a worthy goal.
Now, speaking of stakeholders, and we highlighted the fact that the government stepped in here, so I guess technically we've all got a hand in this going forward. When we think about the cost, and on Wall Street, Bay Street, they're constantly valuing businesses. The stock market is a voting mechanism. For all that has gone in versus what we're actually looking at in terms of the value in the open market, if we're going to start talking about deals, what's the buzz on that front?
The buzz is taxpayers are going to take a haircut. This project currently is not worth $34 billion. Now, what's the exact valuation? It's hard to guess. It depends on how many parties get involved and also how you account for the total value of this pipeline. There's a way of thinking of this. This is what the Globe and Mail went into on the weekend. There's a way of thinking of this as, okay, say the government gets, for the sake of argument, $25 billion. There's sort of a $10 billion gap between what the government can realize and what they've put into it. Well, the other side of it from the government's point of view is if we can allow Canadian oil to go to foreign buyers, if we can eliminate the gap between the price of Canadian crude and the price that crude fetches on the world market, and that's been a consistent problem for Alberta. They're not getting the full price for their oil because they only have one customer.
Yeah.
Then a higher price for Canadian oil means more tax revenues for Alberta and for the federal government, and that's part of the government's overall view. And what the Globe and Mail explained on the weekend, John, was that the additional tax revenues over time could be somewhere upwards of $50 billion. So that's the payoff for taxpayers, is eliminating the gap between what Canadian producers get for oil and the world price for oil.
Just before I let you go, we're going to be talking about an interest rate decision from the U.S. Federal Reserve this week, and a lot of people are trying to figure out what a central bank in the U.S. does as an election approaches in the fall. It gets a little bit complicated. Some people have said wouldn't be surprised if we had an election in this country come the fall, but on this particular subject, since there's a bit of a balancing act that the federal Liberal government's doing, whenever we're talking about growing the economy, but also a push towards greener initiatives, how does that possible timing impact the thinking here?
Sure. If Justin Trudeau's out trying to brag about this project, and believe me, he will be. He wants a win on this. So you get some sort of a deal that allows the government to recoup several billion, like a significant chunk of the money they put in. And then they're going to start talking about the fact that the oil sands has reduced their emissions. And this is where we get into the Pathways Alliance and some other folks who've been regulars on BNN Bloomberg. There are lots of ways to reduce the emissions from the oil sands with carbon capture and some other technology. Some of it have been unproven, so it's not a clean story, but the government's going to continue to invest in Alberta in lowering carbon emissions and in making this oil more attractive to world buyers. So that's the other part of this. And again, it plays into the political situation. There is a greening of the oil patch and a greening of the oil sands that's essential to this TMX story.
Nice to have you with us this morning, and we lead this hour with the latest on Canada's economy, which appears to be running out of steam. We now have an early look at how the first quarter played out. New data this morning from Stats Canada suggesting GDP was flat in March. Meanwhile, in February, growth of 0.2% fell short of economist expectations, and the expansion in January was revised lower, pointing to overall first quarter growth of around 2.5%, which would be slightly below the Bank of Canada's own forecasts. And while the numbers don't suggest a sharp downturn is on the horizon, this data, coupled with signs of easing inflation pressures, could build the case for an interest rate cut by June. Ahead of these numbers, most Bay Street economists were already expecting a 25 basis point cut at that upcoming June meeting, kicking off an easing cycle at a time when interest rate expectations in the U.S. keep getting pushed back. Let's get some more perspective now from Sadiq Adati, he's Chief Investment Officer at BMO Asset Management. Nice to see you.
Thanks for having me.
What's your reaction to the GDP numbers today?
Yeah, not surprising. I mean, we've been underweight Canadian equities now for probably most of this year, if not even part of last year. We just see a slowing economy, not necessarily a disastrous one, but definitely a slowing economy. We're seeing inflation come down. We're seeing a little bit weakness on the job front as well. So overall, I do think that, as you alluded to, the Bank of Canada probably will be cutting rates, I think, in June. Every sign points to it. And the only reason they wouldn't do it is if they're worried about where the Fed is going to be at by the end of the year and not go too far ahead of that. But even I think today they should be moving forward. What
specifically, with respect to the Canadian economy, worries you the most?
Yeah, I think the GDP numbers highlight that it's sluggish growth at best. We're also seeing, again, pressure on the consumer. I think that's another part that really worries me, and I think it's only going to get worse in the coming months with mortgage renewals. But you're seeing consumers, tighten up a little bit of their belts. I think they're being a little bit more cautious how they spend their money. If we have more job losses potentially occurring down the road, that will even cause even more of a detrimental impact on consumer demand. So that together gets me a little bit more worried about where the Canadian economy will be in 6 to 12 months from now.
You talked about, by comparison, the U.S. economy. A lot of people have highlighted the resilience of that consumer. Is this interest rate dynamic and the differences of the mortgage market there, is that one of the considerations?
Yeah, that's exactly it. I mean, consumers in the U.S. are in much better shape. Their mortgage situation is different than Canadian. How much you can amortize that across the board. So they're in a much different position. Therefore, they can still spend on the economy. The top 20% in the U.S. still have excess cash as well. So they're still spending quite a bit. It's the lower end that is tightening up a little bit, but Canada's already past that level. So I would say that Canada's 6 to 12 months ahead of where the U.S. might be. That means that Canada has to start to do a little bit something today, and cutting interest rates will definitely help the consumer.
I spoke to an economist yesterday who described Tiff Macklem, the Bank of Canada governor, as a dove at heart, that in many ways seeing more signs that would open the door towards cutting rates is something that he would likely embrace. Any thoughts on that?
Yeah, I think so. Though I must say that maybe about 12 months ago, he was very much hawkish and wouldn't give into any sign of being dovish. I think more recently, he has definitely been showing signs of being a little bit more dovish. So if it's not June, it's there shortly thereafter. But I do think we're getting that rate cut.
Now, some past signaling from the Bank of Canada complicated matters. I am going back about a year or so, but I do wonder if you start to see more of a disconnect between Canada and the U.S. on rates. How do you think it plays out? Are they in it? Because I guess the significance of if they were to cut in June is I think a lot of people would view that as an official pivot point. We're done with raising interest rates. We're done with holding interest rates. And now we've moved into a period where interest rates are going to come down. How challenging will it be to go more than, I don't know, a couple 25 basis point cuts if the U.S. isn't even cutting interest rates this year?
Yeah, it's going to be interesting for sure. It's not an easy situation. I think what you will see is Canada will start cutting 25 basis points. They'll probably do another one thereafter. But they don't have to go every single quarter with the rate cut. And so if they've done a couple, they can wait and see where the Federal Reserve is at that point in time to decide, where they want to go. But I think they've highlighted, and even Europe's done the same thing, that, the economy is not the U.S. economy. And we don't need to do what the U.S. is necessarily doing. I think they're all aware of what U.S. is going to do. But I think if Canada doesn't start cutting rates, they're going to fall well behind the U.S. And you can see by today's Canadian dollar, the impact that for sure Canada should be cutting rates and U.S. is not. It's having an impact on the Canadian dollar as well.
Yeah, maybe we should show our audience what's happening with the loonie, which really has struggled to make any notable move above 74 cents. And here we are, I believe, below 73 cents right now. You saw some of that immediate impact in the Canadian currency. How does this factor into the Bank of Canada's thinking, do you think?
Yeah, I don't, I think in some sense they're still okay with a weaker Canadian dollar just for the economy standpoint. But I think at some point they're going to be careful about that too as well. I don't think they want to see the Canadian dollar go under 70 cents as an example. So I think anywhere in the low 70s, I think they're still fine. Once you break in that mental threshold of the 60s, I think that's when they get a little bit more cautious.
I do want to talk more sector strategy after our break, but you highlighted that you'd been, on average, underweight the Canadian stock market, in part because of the economic realities. Is that correct?
Yeah, that's right. I mean, knock on wood, I think we've had a really good call in the last year or so. So we were underweight Canadian equities because of what's going on. We saw it being lagging behind the U.S. economy. And part of it is also the strength of the U.S. economy is why we want to be underweight Canada. And the weakness of the Canadian dollar also helps U.S. allocations.
One other tech stock that we've got our eyes on is Pinterest. It is the digital pin board where a lot of people can pin the things that they like. The struggle for Pinterest has been, how do they monetize that? Well, it seems like this quarter they figured it out in a major way. Sales increased by 20%. There's now more users on the platform as they turn it into more of a shopping opportunity. Not only are you just pinning things that you like, but maybe you can buy things that you like as well. Mark Kelly is the senior U.S. Internet equity analyst at Stifel. He's got a buy on that stock as well. Mark, did I kind of sum up where Pinterest is going or what they got right in the quarter?
Yeah, I think you did a very nice job summarizing last night. I would say, just to hit on a couple points, one, you're right, they are making their pins more shoppable, so you can click on the links and actually buy things either right inside of Pinterest or quickly takes you to the right product. That's one. One thing I would highlight is that they are sticking with the AI theme, they're using AI, pretty broadly, and they're starting to do things that are similar to what Meta and Google are doing. And what I mean by that on the advertiser side is making it easier for you to deploy your ad dollars on Pinterest. So there's a new product they're about to launch called ROAS bidding, so return on ad spend, and making sure that you're getting the right return on your investment from an advertising perspective. That's not baked into numbers yet. And then the other thing I'll point out is that, they have fairly new partnerships with Amazon and with Google to bring in advertiser demand from third parties. And those are two great platforms that you want to partner up with.
Even with this rally, the stock is still off by about 50%, more than 50% from its peak in 2021. And, I think there's a category of tech stocks that people think of as Meta, Google, Amazon as sort of blue chip, whereas Pinterest was maybe a little bit more youthful, waiting to grow up. Would you say that Pinterest is kind of growing up and can run in the league of some of those other big players?
I would, from the perspective of execution and from a product roadmap standpoint. I can't suggest that they're going to be the next Meta or the next, Google, just to put it in the same segment, but they're doing all the right things. And I think increasingly, when we do a handful of calls with ad agencies every quarter, we're hearing more interest from the advertising community to advertise on Pinterest, and they're making it, as in Pinterest, they're making it much easier to use them as a platform than they have in the past. So I think that's right.
Well, I was kind of going to contrast it with Snap, right? In fits and starts, they're trying to also get those ad dollars and figure out, well, what's our edge over, Meta's platforms or Google's. And Snap has been very volatile. It recently surged, but you're neutral on that one.
I am. I think it's easier to monetize a platform like Pinterest. Typically, the user base has a very high purchase intent. They're typically there to look for things to buy or to look for ideas, for their apartment or recipes. You go there with high purchase intent. The rub on Snapchat is typically that it's primarily a messaging platform. Messaging is very hard to monetize, especially in the US. So I think that's where they differ. Where they are similar is that, neither of those companies are a must buy for advertisers. There are certainly some segments where, yes, Pinterest might be a must buy. But I think, the biggest issue is a lot of test budgets are needed for both of those companies to do well. In a typical, good year, so to speak, from an advertising perspective, about 5% of budgets go to experimental platforms or on formats that you've never advertised against. Those budgets have been, non-existent for the last 2 years, and those are, slowly starting to come back.
Shares in Franco Nevada took a hit last fall after Cobra Panama, the stream there being their biggest asset, was shut down in Panama. Now, the stock is still down from its level of prior to that. I got it mixed up earlier, but it has been recovering lately. And of course, gold prices near record highs are good news. Paul Brink joins us now, CEO of Franco Nevada. It's great to see you.
Andy, good to see you.
Let's get Cobra Panama out of the way. You got the election this weekend in Panama?
Yep, so we'll be watching closely to see what happens, who the new government will be. I'll say in the lead up to the elections, all of the candidates have been fairly quiet on the issue. They don't want it to be an election issue. But I'm sure whoever gets in power, the First Quantum, the operator, will be looking to engage with them and see if there is indeed a route forward.
Such a chunk of the Panamanian economy. It's a country that is not in great shape economically.
It has its fiscal challenges, and so there's no doubt that the mine would help a lot to address those. But there's popular sentiment that you need to get around, and hopefully a new government can find a way to bring about what I think really would be a win-win for the country.
When you talk to other people in the mining industry, do they just shake their heads? Are they baffled by what's happened there?
The mining industry is familiar that permitting mines is so tough. It takes many, many decades. But once you've got a mine built, once that capital is spent, once you're employing people, you're generating, in the case of Panama, 75% of their export revenues, 5% of GDP, it's very seldom that a country would move to shut a mine down. So this is quite unprecedented. And I hope that ultimately it gets turned around.
But you've written it off, haven't you? You've said for now.
From an accounting perspective, we said we have to be prudent. You don't know what is going to happen, but we still are hopeful that there is a resolution.
Your revenue coming in at about 256 million in the latest quarter. Now, it was down 7% year on year. Is that Cobra Panama?
That's Cobra Panama. Cobra represented about 20% of our revenues. So outside of that, the portfolio is growing. We're actually going through a period. We've got royalties on a number of new mines that have been built. The first
happened this quarter. Salares Norte, which is Goldfields down in Chile, a large mine. They poured the first gold. We've got a couple coming up in the next few months. Equinox should pour first gold at Greenstone.
In Ontario.
Which is in Ontario. It'll be roughly 400,000 ounce per year producer.
That's a big mine.
Yes. Yeah. And short on the heels of that should be Tocantinzinho, which is G Mining down in Brazil. Smaller mine, but we've got a larger interest. We've got a stream there on 12.5% of the gold they produce.
How much gold would you get from that Brazilian one? Would you say?
It's 200,000 ounces a year plus.
The mine is.
The mine is. Yeah.
And you get roughly 12% of that. Yeah. Just update us, how much of your portfolio is oil and gas now, or your
We're
revenue?
roughly 20%. About 75% is precious metals, about 20% oil and gas, and then iron ore makes up most of the difference.
How much is iron ore in your portfolio?
About 7-8% currently.
Right. Would you enlarge that?
It all depends on assets. We're so fortunate with the iron ore assets. The two we're in, the one is we cover Vale's operations in Brazil.
Okay.
And particularly the Carajás. The Pilbara in Australia and the Carajás in Brazil are the two best iron ore bodies. The other operations we cover are Rio Tinto's operations in Newfoundland, Carroll Lake, which again produces a very high quality pellet that trades at a premium. So we'd be interested for quality projects.
Right. Your dividend yield only about 1.2%, but that's just your model. You tell people, we're going to build value within the company.
Well, what's happened over time since our IPO 16 years ago, we've seen such good share price appreciation, about 15% per annum. Many of our shareholders bought the stock at IPO, so they're yielding 10, 12%
nice.
on their cost basis. And so we're, part of it is the share price has appreciated so much that it's kept the yield at the level it is.
So the stock's about 166 now, Canadian. What was the IPO price? Do you remember?
We were 15.20.
15.20, and have you done splits at all?
No splits.
Oh, so it's been a 10-bagger for people.
Yes.
Along the way. Yeah. What about the much vaunted critical minerals, the lithium and cobalt? I know I've asked you this before, but have you put your toe in there at all?
We are active. In particular lithium, the sector has taken such a hit in terms of investor sentiment. Very little access to capital right now.
Okay.
And so we're working hard. Ideally, people who have projects to build or even have started building projects that now aren't able to raise that incremental capital, there may be some attractive deals there.
But how would that work? I mean, they don't produce gold and silver from lithium, do they? No.
So this would directly be an exposure to the lithium.
To lithium, yeah, because it's not a byproduct type deal at all.
So,
what about cobalt? Have you thought about going into the DRC or?
Similarly with cobalt, if we found a great asset, we'd invest.
Yeah.
The tough thing is, yes, most of the world's cobalt does come from the DRC, so you got to add the political risk element to it. So for the right project, we'd invest.
I saw a great documentary about DRC on Prime about the cobalt mining, and they showed a mine, and it was scary, no safety equipment or anything. Yeah. And I presume that was one of the better mines if they allowed it to be filmed.
Yeah. No, I think some of it is quite tough.
So what's next? How much cash what is your firepower? You usually have plenty of available capital that you could deploy. How much do you have roughly?
So we have no debt, and we've got $2.3 billion in available capital. That's $1.3 billion in cash, $1 billion of available facilities.
$1.3 billion, yeah.
Just in cash.
That's a nice position to be in. I guess, is it tough though now with this high gold price? The gold miners aren't so starved for financing.
What we're seeing, it's very active at the moment in terms of deal activity. Most of it is byproduct. So it's the base metal producers where you've got precious metal as a byproduct and you can monetize it in this sort of an environment. That's a very attractive source of capital.
Yeah.
So there's a good amount of deal activity.
But is it tough? I mean, not that many new base metal mines are being built around the world, I thought.
There's some activity. Some of it really is around recapitalization. Some of it is about advancing new mines to construction.
Yeah, and it's such an interesting thing. You've got this alchemy. People don't really care when a base metal producer produces gold. It gets no value for it, really.
Yes, so often in the commodity markets, people focus on that primary commodity. That's the exposure they're trying to get to their shareholders. Mm-hmm. So if they can raise capital by selling a byproduct, it's often attractive. And you've seen in our industry, all of the big precious metal streams have been byproduct streams, typically on big copper mines.
Copper and gold. Were you surprised that BHP is approaching Anglo American?
I can't say I was expecting it, but I think the read-through is a theme that we've all been speaking about, and that it is so expensive and so risky building new mines because of the cost inflation, because of the permitting risks. I really think that what the BHP bid shows is it's cheaper to buy than to build. I think the implication really is for the copper price. It means, BHP is, if they're buying mines, they won't be building mines. It means probably less supply. I think it's very bullish for the copper price.
It's time for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Paul Gardner. He's partner and portfolio manager at Avenue Investment Management. He wants to talk about something that economists have been noting for some time, and that's sagging productivity in Canada.
It's an obsession in Canada, and for the longest time, I just thought that no one come up with the right numbers. How could we be that less productive than the U.S. constantly? But you're starting to see a continued streak, and there's a couple of real big issues that at the government level right now, there have been such mess ups that the immigration file. Canadians love immigration, but they didn't understand that when you bring in 1 million immigrants in, you have a tremendous housing problem. And so much of the sector, because we now have to build housing, that's not the best place to talk about productivity is to put money and capital into housing. And then secondly, the carbon tax was messed up. So there's these mess ups by the government currently that has caused a problem with that. But really the bigger issue that has no blame on the government is that when you're competing with a neighboring country that is throwing trillions of dollars of money in capital spend on infrastructure, it's very hard to compete because they're running such massive deficits. We can't run massive deficits. So, when everyone starts complaining about the government of Canada running a deficit, we're only talking 1 to 1.5% of GDP, whereas the U.S. is running 6 to 10. And it's also when you're a reserve currency, you get to run your monetary policy how you want. And so it's very hard. It's almost like you're competing with your hand behind your back tied. And it's one of those factors where it would be great. The biggest issue though is the huge issue is deregulation in this country. We're still haven't deregulated this country, whether it's in telco, airlines. That has to be done. We cannot protect the Canadian cultural at this point now. We've done it for 30 years. It doesn't work. So in the end, we need a ton of deregulation. We need a bit of tax movement policy that's smarter. We have all these isolated tax innovations or ideas that cause accounting firms to get their head exploded because they're almost like PhD now. They have to. When you talk to your accountant now, there's so many different line items that it's very hard to enhance productivity when there's so much confusion at the accounting level. So then when you if you could lower taxes, increase deregulation, then you actually could create not just winners and losers, but you create en masse the country could perform better. And then finally, this is a blame on all government levels, is the provincial trade barriers are just unbelievably bad.
Right. And there's been unbelievably no movement on that. For decades
and it's like a third rail. The provinces refuse to touch it. They have their own little pet projects they're just terrible. And in a country like this, to have trade barriers provincially is just horrendous. And you'll never get productivity up if you don't have governments that come together and say, can we not have a free trade deal in our own country? And that's probably our biggest problem.
What about capital spending by the private sector?
Yeah, and we're not being incentivized enough. So we're always going to lag behind Silicon Valley and the U.S. But you can create. Once again, the government at this level right now is creating winners and losers instead of en masse just making it easier for small businesses. Even like an example is small business taxation almost forces you to stay small because your taxation rate is so much lower than large. So why do you want to even grow into that? Because you're not going to get as much dollars because you're going to be taxed more. So there's this, and then of course the capital gains thing that kind of blew up in the government's face. And I'm not a proponent on either side, but it still causes so much confusion. And long-term capital has a problem placing money in Canada just for a lot of those reasons. The deregulation thing. There's just so many pillars that are causing productivity productivity to stall, in effect.
This doesn't cause you to have a negative view of the Canadian stock market, however.
Well, it's not a great thing, but it doesn't overtake the whole valuation idea and that's actually why we have to accept Canadian valuation has to be lower than the US valuation, but it's now at the point where it's just too wide. But we're always going to trade at a discount. Look at our currency. And then there's just finally, I don't know if I have enough time, but there's something else that it's a blessing and a curse. They call it Dutch disease in the sense that you have this commodity that's a super commodity in Canada, oil and gas, and it generates, I believe, something around $25 billion at the federal level of revenue. So when you have this resource that does so well, unlike Japan or Singapore, when you have to pay for resources and get no good benefit from resources, you don't have to lean on your economy to create more technology and more productivity because you have this old commodity that basically takes over the whole discussion.